Greetings and welcome to the launch of the RIMS Bermuda 2020 webinar series presented by RIMS and the Bermuda Business Development Agency. This session is titled Managing the Increasing Cost of Catastrophe and Climate. This session will be hosted by Jasmine DeSilva, Business Development Manager of Risk and Insurance Solutions for the BDA, and she will be joined by an esteemed panel whom she will introduce shortly. I am Justin Smollison, Business Content Manager at RIMS, the Risk and Insurance Management Society. A few notes before we begin. If you have a question for our presenters during today's session, please submit them by writing in the question box and feel free to ask at any point in the presentation. We will reserve time at the end for Q&A. Jasmine and moderator Suzanne Williams-Charles will moderate that segment. Following this session, the recording will be available on Opus Ed and Risk Knowledge, the RIMS online content library. All downloads and related contact information will be accessible to the sponsor. And on to today's session. Over the past 2 decades, the Bermuda reinsurance industry has paid billions of dollars in claims arising from some of the world's most severe natural catastrophe events and largest man-made disasters. Indeed, the effects of climate change will become more significant in the years to come, with the potential for unprecedented losses. Bermuda's historic role in natural catastrophe reinsurance makes it an ideal champion in the efforts to optimize and extend the use of insurance and risk management capabilities to build greater resilience and protection for people, communities, businesses, and public institutions. RIMS and the BDA, the Bermuda Business Development Agency, are thrilled to be joined by a large global audience. Welcome all. BDA Business Development Manager Jasmine DeSilva will introduce our panelists and begin the discussion.
Thank you, Justin, and good afternoon, everyone. I'm delighted to welcome you all to the second episode of the RIMS Bermuda webinar series. This 5-part series was developed to shine a light on the key issues and trends currently shaping the risk management landscape and Bermuda's unique role in addressing them. Last week, we just focused on an overview of the Bermuda market and discussed how Bermuda became and continues to be one of the world's most important insurance and reinsurance hubs. The panel touched on Bermuda's historic and significant role in natural catastrophe reinsurance. And today we are going to explore how Bermuda is building on that expertise to become the world's climate risk capital. And so today we have joining us Suzanne Williams-Charles. She is the Director of Policy and Regulation and Corporate Secretary of the Association of Bermuda Insurers and Reinsurers. As a representative of ABER, whose members do business in more than 150 countries, and with a wealth of industry experience, including a decade of regulatory experience with the Bermuda Monetary Authority, Suzanne is well placed to moderate today's discussion. So welcome, Suzanne. Would also like to welcome Andrew Engler, CEO of Kettle. He has a digital background in the industry, and he's passionate about the use of technology to better understand risk and close the global insurance gap. At Kettle, technology is used to model and predict risk in all areas vulnerable to climate change and to find hidden patterns driving catastrophe risk. I'd also like to welcome Lara Mori. She's the Managing Director and Head of Global Property Practice at Guy Carpenter. Lara specializes in developing solutions for difficult risk and is the firm's acknowledged expert in the Florida property market and has served on the Florida Hurricane Catastrophe Fund. So welcome, Lara. George Petropoulos, he is the Assistant Director of Supervision at the Bermuda Monetary Authority. George is responsible for the supervision of Bermuda's insurers and was recently involved in the development of the authority's wildfire and typhoon survey published in March of 2020. Welcome, George. And last but not least, Stephen Weinstein, the General Counsel at Renaissance Re and the Deputy Chair of the BDA. He is the Chief Legal Officer and is responsible for legal, regulatory, government affairs, and compliance matters on a global basis. He also serves as the chair of the Renaissance Re Risk Sciences Foundation, which is committed to researching and developing risk mitigation techniques. So without further ado, I'm going to hand it over to Suzanne so we can start this great panel.
Thank you, Jasmine. And again, welcome to everyone that is joining us today. As we have under an hour for such a huge and important topic, I think we should just dive right into the discussion. You know, as was mentioned in the opening comments, Bermuda has a long history of being the optimal jurisdiction to mix risk and capital. I've known Steve Weinstein for over a decade, and what's been very clear during that time is his passion for Bermuda. In my role at ABIR, which I only undertook 2 years ago, I've come to understand that he has a similar, if not equal, passion for climate risk, climate change, and the impact of that globally. So maybe we can start first. Steve, can you discuss maybe what makes Bermuda uniquely placed to be the climate risk capital?
Well, thank you, Suzanne, and good afternoon, everyone. If you were in Bermuda, you would be in the afternoon. It is our tradition to wish you good afternoon. Thank you for that very kind introduction. Thank you as well, Jasmine. And let me quickly thank both RIMS and the BDA for your perseverance on continuing these events and our virtual paradigm and bringing together what I know is a great audience of people interested in coming to these topics. And thanks also to all of you for participating in this format. Next year, you will be in the building that you can see in our on-screen logo here, and we look forward to seeing you in person and to engaging with you in this format today. You know, as Suzanne mentioned and Jasmine and the intro speaker, and if you participated last week, you may well have heard, and it is true, that Bermuda for the better part of 3 decades has been the ideal, the best jurisdiction in the world to match global risk and global capital. That's true for significant risks like excess casualty lines, for natural disaster risks that are not climate related like most earthquakes, but it's been particularly true for climate related natural disasters because in so many respects, the Bermuda market, as we know it today, has its roots in a significant natural disaster, Hurricane Andrew in 1993. Since that time, for every major market dislocation, including the current one, whether it was Hurricane Andrew, 9/11, the frequency events of 04 and 5, Katrina, Rita, Wilma, and others, we have seen waves of capital formation to Bermuda because no jurisdiction combines Bermuda's strengths in the way that Bermuda can. Part of that is the expertise that has built up over these 3 decades around liability risks and earthquake, but particularly around climate-related hazards. That skill set and the nimble, fit-for-purpose regulatory framework have been a great platform for traditional reinsurance, alternative reinsurance solutions, insurance solutions, and are identically well suited to serve as a foundation for the accelerating sector of climate risk finance. Against that backdrop, and I think our introductory speaker mentioned the billions of claims that Bermuda has paid across this years. Bermuda has indeed paid its claims, in a story that I think is undertold at times. The default risk of Bermuda insurers and reinsurers in this modern era is literally 0. It's not approximately 0, it doesn't round down to 0, it is 0, outperforming any other known sector of financial instruments of which I'm aware. Bermuda has risen to meet every major market challenge of the last 25 years and can do it for climate. The people, the skills, and the regulatory framework are going to migrate very naturally into this most adjacent set of climate risks. And I'm optimistic for our ability to do that, to help our existing customers and the communities they serve, but also to reach out to new customers and communities on a worldwide basis as we collectively work to provide solutions for this very significant set of challenges we face.
So Steve, you know, connected to that, I also know that you have been very involved in the Bermuda Institute of Ocean Science, which, you know, by definition is looking at the ocean, the impact of climate change on the ocean and the weather and those types of things. So maybe, you know, can you talk a bit about the work there and how it also contributes to Bermuda and overall the effectiveness that we can have as a community in this climate change battle?
Yeah, thank you for that, Suzanne. So the Bermuda reinsurance sector, our regulator, our companies, organizations like ABIR are clearly world-class. Another world-class organization that predates all of those is BIOS, the Bermuda Institute for Ocean Sciences. For more than 100 years, BIOS, a US-regulated charity, has been operating out of Bermuda because Bermuda is the best place in the world to study the world's oceans. We're out in the deep ocean, and I will spare our listeners in the interest of time the fascinating geological uniqueness of Bermuda. But between our unique position out in the deep ocean, adjacent to the Sargasso Sea, surrounded by the world's most resilient and interesting coral reef, in that it's the coral reef farthest from the equator, and surprisingly resilient to climate fluctuations. BIOS has played an extraordinary role over the better part of a century of sharing data, information, and findings with a broader global community. The number of Bermudians who've trained up as interns or as academics or senior scientists at BIOS and have migrated into the reinsurance sector deserves its own webinar because it's a fascinating story. But that synergy between a globally operating financial services industry keenly interested in rising temperatures in the world's oceans and their now proven contribution to rising severity of hurricanes and likely floods with an existing set of expertise turned out to be the accidental marriage made in heaven. As we move forward and look at the world's next big set of risks, the financial risks of climate change, including pandemic, which is clearly contributed to by accelerating climate change, our proven set of ingredients to address both the financial solutions, but to partner with an organization like BIOS, which by a happy stroke of fate happens to be down the road from us, is just another set of benefits that Bermuda brings. And when our webinar visitors find their way back to Bermuda, when the dust from all this clears, I'd invite you to go visit the BIOS campus and meet some of the really extraordinary scientists doing fascinating work there.
Thank you, Steve. So Steve, as was introduced in his bio, represents one of our global reinsurers that are based here in Bermuda with significant operations. Lara, you are representing Guy Carpenter, a broker community. Maybe you can add a bit or talk a bit about why Bermuda is optimal for Guy Carp to be operating from within. I mean, we all know that Bermuda is a small island. It is not the UK, it is not the US. However, it's still the choice for many global reinsurance companies and global broking houses. And so can you share a bit about why you believe this is the case and why Bermuda is chosen over and over again?
Yeah, absolutely, Suzanne. I would just echo so many of the comments that Steve made regarding the level of passion for this topic, catastrophe reinsurance, the birth of this coming out of so many events that have happened over the last number of years, and the concentration of not only talent, but really the drive to find solutions, to take on the idea of marrying capital with expertise, with the ability to understand ways of measuring risk. You know, the insurance and reinsurance industry is really driven by the ability to quantify what the risk is. And if you can quantify it and you can get comfortable with it, you can have discussions with those capital providers to say, here's a reasonable way to put your capital at risk. Reinsurers have been doing that for years and years and years. And the thing with climate is it's a somewhat difficult to understand evolution of the way that we look at risk and understand risk. And Bermuda's on the leading edge for capital providers worldwide in trying to really delve into what this marriage means between understanding the evolution of risk, thinking of ways to create products and to attract capital to better manage these exposures long term. And if you begin to lose the ability or lose the confidence in the way that you calculate risk and measure risk and fit it into a box, then it's more difficult for capital to say, we're going to come to the table and we're going to get together as an industry and we are going to provide solutions as to how we move forward. So this concentration of expertise and married with passion in Bermuda to be able to move these ideas forward, I think is really critical, because it's a difficult topic. And it's not one that there is a consistent, everybody can look at this piece of information and know and understand exactly what has to be done, and there's complete agreement as to how we would move forward to solve this problem. You know, that's not the dynamic we're dealing with. So being able to pull in different opinions from varying communities in terms of the reinsurance expertise, the scientific expertise, academic expertise, all coming together in touching those Bermuda entities, and you know, for Bermuda to have the ability to reach out as needed and bring that into providing those solutions is it's critical. You know, we wouldn't be able to place the billions of dollars of catastrophe reinsurance worldwide that is necessary and required to keep economies moving forward without the support of the Bermuda industry behind that. You know, it's absolutely essential.
Thanks, Lara. So before we move on, we can touch on Insurtech. So Andrew Cattle, we've talked about the Bermuda market, we've talked about its nimbleness, we've talked about the Bermuda regulator. Cattle could have chosen to be anywhere, and they chose Bermuda. Can you maybe chat us through that decision and why Bermuda was the right choice for the Insurtech business that Cattle is looking to move into?
Yeah, absolutely. And there was never really a question of where we wanted to locate ourselves or where this would be built out of. There's a couple reasons that are really primary. First, the BDA and BMA have been incredibly innovative over the past couple of years, and the government as a whole has been so positive on technology and Insurtech and supporting that. And even just our experience, and I'll give Jasmine a shout out for being so amazing. They literally can handhold you through a process and help you with something that might be much more complex regulation that you'd normally have to hire in multiple law firms, which then makes it even more unattainable to a startup that has low starting capital. They're really, really great at supporting and helping you understand the process. And along with that, just give a shout out to the Sandbox program, which is an innovative design. And we've seen it happen before, you know, in some US states. And because of the complexity that's still around there, and there's a lot more complexity in the US because each state is separately regulated by insurers, you have this one sandbox inside Bermuda that allows you not only to connect to the government, connect to the BMA, but also connect to the traditional reinsurers and sources of capital. The second thing I'd say too is there is really nowhere like Bermuda in the world when it comes to the type of environment and the close connections and personalities you have. And it's more of a qualitative metric. I think it's something that's a little bit more reminiscent of what Silicon Valley looked like when it was starting up and why it exploded so much in technology. It's incredible that you can go down to Harry's or somewhere local and have someone who's been in the industry 30 years and is in a C-suite position sitting next to a modeling actuary who just started up 2 months ago. And I think that's absolutely critical, especially when you talk about an Insurtech side where reinsurance, you can't even Google half the terms that you need to understand to start. If you throw seeding out to one of your developers or data scientists, they ask if you're planting seeds or what you could even mean. So it's critical to have this great knowledge base that is very easily connectable and very relatable on a personal level that allows new entrants to understand that industry and work together. And it creates a much better environment than thinking, oh, here's Insurtech trying to come in and you know, steal everyone's lunch and break it apart. Or the other side of it, you know, the incumbents are trying to push Insurtech out. It just creates this beautiful melting pot for it.
Thank you, Andrew. So maybe we can move on to kind of the next area, and that's really talking about Bermuda's reinsurers and their participation and their support of catastrophes historically and their role. So there's been an undeniable increase in the frequency and severity of natural catastrophic events over the past few years. And you know, the data's proven that Bermuda reinsurers have taken a significant share of these risks. I know that the Bermuda Monetary Authority has done quite a bit of work on this in the recent past. And George, maybe you could walk us through the work that was done on these particular events and give us a sense of the Bermuda market and its participation.
Yes, thank you, Suzanne. So just to provide a bit of background, if you look at the catastrophe losses of the decade of 2010 to 2019, you will see that they have been actually the worst on record. And then you can also see that the decade of 2010 and 2019 is also the warmest on record. And you're seeing a trend in terms of increasing frequency and severity of catastrophe events. As my fellow panelists have highlighted, the importance of the Bermuda market into assisting the local communities to recover from such events cannot be understated. And I think a good example for that is the BMA's 2017 US claim survey, where it was highlighted that the Bermuda insurance market covered approximately 30% of the hurricanes of Harvey, Irma, and Maria in 2017. Another trend that you are seeing, probably underlined by climate change, is not only deterioration in peak perils, but also the secondary perils also becoming more extreme. And this is where the BMA's recent wildfire and typhoon survey comes in, where you can see that wildfires have becoming more and more material over time. So this survey summarizes results from BMA's data collection exercise. This exercise survey was focused on the California wildfires of 2017 to 2019. So under there you have important catastrophe events such as the Tubbs fires and the Camp Fire. Also, you had the 2019 Australia wildfires as a period that we surveyed, and the impact of those are still probably quite fresh in memory. And then additionally, we also looked at the typhoon losses in 2018 and 2019. This was a market-wide survey with a total of 91 participants, and it spanned across Bermuda insurance groups, non-life commercial insurance carriers, as well as special purpose insurance vehicles. Just to give you an understanding of the magnitude of the survey, the total capitalization of these entities was in the region of $100 billion. One of the key messages from that survey was, again, the Bermuda market importance in terms of covering those wildfire losses in California and typhoons in Japan. So just to give you an understanding in terms of the numbers, the Bermuda insurance market paid approximately $9 billion of gross claims, or approximately $5 billion of net claims for the last 3 years of California wildfires alone, and an additional $9.6 billion of gross claims, or $5.4 billion net claims were paid for the 2018 and 2019 Japan typhoons. The Bermuda insurance expected payout for the Australia wildfires is quite a bit lower. It's at the 0.3 billion of gross claims and 0.1 billion on net basis. This is, however, largely a reflection of the fact that compared to the other surveyed perils, the Australia wildfires, even though on a standalone basis and their communities that have been very important, they're not as material. So just to give you an understanding, the estimated insurance industry loss for the New South Wales fires of 2019 is between $1 and $2 billion, which is only a fraction of the 2018 California wildfires, which is estimated between 9 and
Maybe we should
Okay.
move on while George and audio. Is your audio back, George?
Yes, for some reason the connection dropped. Okay, apologies. As I was saying, another message that was coming out of this wildfire and typhoon survey is the materiality or the importance of the Bermuda market from a financial resilience perspective and from an insurance capacity perspective. And even though these events have been particularly material for the specific regions and local economies, overall on the insurance market, they have had minimal impact. So by way of example, the highest sort of net annual loss to capital surplus ratio that we observed was only 2.5%. So I would like to sort of summarize the points and sort of try to say that the key message from this survey is really that Bermuda is not only an important player in covering catastrophe perils from the more peak sort of areas and catastrophes, but also in the emerging secondary perils as well.
Thank you, George. So, I mean, those numbers speak for themselves. Obviously, Bermuda is a very, as George has just summarized, is very important to the coverage of catastrophe and climate-related events. So with that, you know, I think we've discussed when we were preparing for this, there are obviously challenges from a reinsurance perspective. Information is power, and understanding risks is very important to being able to price risks. And it would be really interesting, maybe Lara, you can start us off from broker perspective. What are some of the challenges that the broker community is facing with respect to the continued changing and increasing severity and really uncertainty around some of these potential future events? What are the challenges that are being faced, and how can these challenges be mitigated?
Yes, Suzanne, I think one of the words you used is critical, and that's uncertainty, because there is a significant amount of uncertainty around where this all goes. What does it mean over the next 5 years? What does it mean over the next 10 years? Are we, you know, some people, and this is a challenge that we face when we're thinking about putting out materials and guidance to our clients and our brokers. How do we address this topic? Because I think at times it feels overwhelming. The scale of it feels very long-term and very broad, and you almost get stuck in this avenue of, well, it's just bigger than I am, right? So there's not much I can do. If global warming is happening and the ocean temperatures are going to rise, what am I going to do about it, right? Or how am I going to address it? Or alternatively, the impacts really aren't going to be felt for another 100 years. So I can't act now, or I shouldn't need to act now to do anything about it. And I think that's one of the biggest challenges that the industry faces, is how do you motivate and find solutions for something that there is a wide range of scientific evidence around. So there's not necessarily there's agreement that it's happening. There's not necessarily agreement on what that means, right? How do you measure changing risk based on this really wide range of outcomes and volatility around results? And what does it mean if sea surface temperatures rise to landfall probabilities of hurricanes? Because it only matters if a hurricane hits something, right? In terms of losses. So all of these questions are out there, and they're unknowns. And I think it's just human nature to react to what's in front of you. So where we've had the most necessary and essential solutions, it's been in response to something. Steve mentioned earlier Hurricane Andrew. Nobody really appreciated until Hurricane Andrew happened what an event like that would entail for consumers, for the people living there, for the state or states that were impacted, for the insurance industry, for the reinsurance industry, right? And that event defined a whole new set of circumstances, and there were outcomes from that, and there were responses. There were government responses. The Florida Hurricane Cat Fund was formed. We saw similar things around California earthquake and the formation of the CEA. We're seeing that right now with the environment that we're all in, living through a global pandemic. There will be solutions that come out of this. You know, you get public-private partnerships. You get the discussion around how to manage the things that are in front of you. But with climate change, you see it in a much broader, slower moving context. So we've had an increase in frequency, but is that a cycle or is that a climate change? And how do I plan for that? And how do I talk to my underwriters about how we want to price risk? Not me, because we don't have underwriters, but how do we talk to the underwriters? How does Steve talk to RenRe's underwriters about how risk is priced and what's the changing view of risk. So I think, Suzanne, that's really one of the challenges, and one of the potential solutions is looking at incentive, right? How do we incentivize capital to want to support catastrophe long term? How do we incentivize reinsurers and brokers and insurers to innovate product that more appropriately addresses the risks that we're going to face in the future? And I know a topic near and dear to Steve's heart that we've had a lot of discussion on: mitigation, because we just don't make it through this without a really substantial investment in mitigating the risk. We can't just put more and more and more dollars into this. We can't expect Bermuda to come up with more and more money and for those reinsurers to pay out more and more claims, and to charge consumers increasing amounts of premium in order to move forward, right? We have to find other ways of navigating this landscape, and mitigation is going to be absolutely critical to that process.
So Steve, would you like to add anything? Lara all but handed the mic to you, so let's hand it over and see what you have, if you have any comments on this.
If we were together in person, I would visualize that mic handoff, but
Yeah.
I'll start by thanking her for all those comments and endorsing everything I just heard, and maybe a couple of quick supplements, because Suzanne, you also originally asked, how can we as a sector help support our collective clients and their communities with the challenges of data in respect of a new and emerging peril? You know, one line I use is, there's always more data available than you think. And yeah, for some of these risks, a new solution, there may not be that traditional 40, 50 years of claims file and a literal file or red manila envelope that the attorneys have in the back office. But there very well may be an extraordinary amount of actionable data on which underwriters can price risk available somewhere. And some of these sources are tech-enabled. Satellite imagery, other sensors, LiDAR, the types of data that our various devices are collecting can be a really rich source of actionable data. And I think there are a wave of emerging tech-enabled strategies to play a role helping to match capital to solutions on the basis of data that's available. Also to accelerate into these opportunities. You know, an advantage 20 years ago was to have better tools, superior models, superior proprietary data sets, and to outperform on that basis. You know, we're increasingly talking about being increasingly open to open source, to bring solutions at scale for these opportunities, to have a trading market develop more rapidly, open source solutions which are transparent as to the source, scale, depth, and verifiability of the data, increasingly useful perhaps. And then finally, too, to have a mechanism to feed back to that virtuous loop that Lara closed with mitigation. We are not going to encourage consumers and businesses and governments to invest in mitigation if they ignore perils or have their recovery without any cost or incentive to build back better. The most effective tool to encourage it is market-based price signals. Cars are safer because insurance underwriters are allowed to charge risk-based automobile premiums. Homes have sprinklers and we collect data about fire risk because of risk-based pricing signals. And for this new class of climate-enabled risks, challenging as they are, we have to permit market-based pricing mechanisms to operate. But the flip side of that will be to reward mitigation, reward adaptation, and ways that perhaps we can foresee and ways that are perhaps completely unknown right now, if we can enable innovation to see an opportunity to participate.
Yeah,
How important is
Suzanne,
sorry,
if I could just jump back in.
Absolutely.
Thanks. I think two words that Steve used are so critical. You know, differentiation is something that we're seeing in increasing levels throughout the reinsurance industry, and that doesn't necessarily directly relate to climate change, but it is going to be a critical component of how we move forward. And reinsurers and insurers are just becoming more and more adept at being able to take data and react to that data and slice and dice information in order to say, you know what, these risks are really attractive for these reasons, and I'm going to focus my capital on those risks. And these risks over here, not so attractive. So I'm either not going to focus capital on those, or I'm going to charge more if I'm going to be incented to bring my capital to those risks. And if we can find ways to push those signals all the way through to the consumer, then you can start to actually incent some of that mitigation behavior as well. If I'm a consumer in California and I know that building my house with fire-resistant strategies is essentially going to cost me the same amount of money as building my house without fire-resistant strategies, and my insurance company is going to say, I'm going to charge you X and Y, depending on which strategy you pick. Why wouldn't you build your house with fire-resistant strategies? Part of that's consumer education, right? People just don't know. Builders don't share this kind of information. So how do we take on the campaign of really educating and incenting people all the way down to the level of the choices they're making on location to build their houses in? Don't necessarily build your house in the WUI where it's going to burn down. If you do, make sure you're following some certain protocols around that. Same thing with flood. We may not have the reams of data, as Steve referenced, across all of these perils, across the breadth and depth of the kinds of things we need to do, but we know areas that are prone to flood, and we know areas that in the future, over the next X, Y, and Z number of years, are going to be prone to flood. And there needs to be mechanisms to deal with those types of things.
You actually took the words right out of my mouth. I was actually going to ask about how important is consumer education. So you've already highlighted that. So before we move on, does anyone else have any comments they would like to make on this particular area? Andrew, anything?
Yeah, I'll add in, and Steve and Lara put it perfectly. And also know it's very dangerous to bring up data, because I'm going to instantly start nerding out about it. And to dive a little bit more in, that really is the key to it. So, when you look at climate change, the current way most modeling is done is by looking at the past 100 years or 500 years and seeing those events. Well, when you have a fundamental change in the risk, like having an increase in heat, in brush, and decrease in precipitation, now all of a sudden the risk today and the fundamentals of that risk have changed dramatically from what they were historically. So saying the next 10 years is going to look similar to the last 100 is no longer a true statement. The amount of data out there is absolutely mind-blowing, and insurance is one of the original data sourcing and data focused industries, and has unfortunately kind of backed up to some of the newer tech companies and tech industries that focus in it. 90% of all the world's data has been created in the last 2 years, and 80% of it is all unstructured. So exactly like Steve is saying, you have MODIS and LIDAR, multiple satellites that NASA has had since '98, since Clinton was president, running on 2-second arc cycles, giving that information, giving real-time information about thermal anomalies, about vegetation indices. And it is a Herculean task to take. Right now, we currently look at 3 petabytes of data, which alone is about $80,000 in cold storage at AWS. So not very attainable for many startups to foot that bill. But when you start talking about something that's open source, this is all critical data that we could really all use, work together to one, translate it into a readable format, and then have actionable insights on it. And that kind of leads me into the second point of machine learning and AI. I hear it talked about a lot, and I think we do a bit of lip service towards it, but I always like to tell people I'm not a genius. I'm just really good at copying what the capital markets did 10 years ago. And if you look, the capital markets were in similar positions in about 2001, 2000 era. 15% of the market was algorithmically traded and machine learning driven. By 2009, that number had gone from 15% of the market to 85% of the market was completely algorithmic and machine learning driven. So when this does happen, it happens very rapidly. And we've already seen a lot of success there. And, you know, there are companies like the other Renaissance Technologies, which has had incredible returns over a 30-year period using purely quantitative and machine learning driven strategies. So I think there's a lot we can learn and a lot we can take from that success that they've had, and also apply to being able to not only help our industry, but like everyone's been saying, to deliver those insights for free, because it helps us at the end of the day. If you can tell a legislator, please stop building in the middle of the forest, or you can say, hey, these are all the areas that are going to get surcharged 30% next year unless you have a controlled burn, and kind of creating that fluidity, which just takes data and transparency.
Thank you. George, is it anything that you'd like to add?
Thank you, Suzanne. Very briefly, just commenting on sort of Andrew's points. I think from a regulatory perspective, our objective is to be able to facilitate this innovation, and there's a number of steps that we've taken, and I think what is probably more relevant in the specific case of machine learning and data, what comes to mind is the Insurtech innovation initiatives that the BMA had recently in terms of the innovation hub and regulatory sandbox, which are BMA's two main avenues for companies that seek regulatory guidance in terms of trialing and rolling out their innovative ideas. There is a separate discussion and webinar on that on July 1st. So my BMA colleague George Alayon will be able to expand on these further.
Thank you, George. So we've just discussed the increase that climate-related incidents have had, and the challenges that climate change presents to underwriting. Maybe, while it doesn't appear that there may be one actual solution, maybe we can chat a bit about the role of a reinsurance in helping build resilience and closing the protection gap, and kind of what can we do as a reinsurance community in partnership. There are programs such as TRIA and the NFIP and those types of things that already demonstrate that partnership. Maybe Steve, would you like to kick us off?
Yes, thanks. I'd be happy to. And as you say, Suzanne, there's no one solution. Nothing will be the only solution. But I'm duty bound to observe that reinsurance is always a solution. But let's step back a bit, and maybe we can point out two underlying dynamics and principles that I'd urge all of us to have in mind as we grapple with these challenges. One is I'd love us all to aspire to close the protection gap for consumers at home and worldwide. And at home, for this purpose, I mean the United States, my original hometown. But we really ought to aspire that a consumer of insurance has true multi-peril coverage with the minimal number of exclusions and loopholes. If you buy something that protects your home, it should protect your home. And the markets and perhaps governments can tranche that risk out behind the coverage, and we should stop asking consumers to securitize their own exposures. So I believe that pretty strongly for consumers, and I think the same thing is probably also true for small businesses. We really ought to aspire to give an SME comprehensive multi-peril coverage and let markets and governments backstop that risk behind them with more sophisticated tools. That's where the protection gap starts. When we scheduled this webinar, it would have been a physical meeting. Even then, we would have said an enormous challenge for the developing world. At that time, it's even more true today, is the enormous deficits that are now pandemic, if it were, across the developed world. And of course, they're even worse. The financial debt in hamstringing of resources that government after government, state after state, sovereign after sovereign has built up over this last quarter or two is astronomical. But that dynamic is also an enormous opportunity for global private capital to tailor solutions to close the protection gap with consumers and small businesses in mind on the one hand, but also to relieve taxpayer burdens for poorly understood, under-modeled, taxpayer-absorbed exposures. These are frequently perils we already know how to underwrite, or immediately adjacent to perils with which we're quite comfortable. I think a lot of the energy on this call as we have conversations and prep forward is very forward-looking. So to be solutions-oriented and to have the confidence in our tools and capabilities including our ability to manage uncertainty. We don't need to have perfect solutions. We need to have toolkits to grapple with and address known uncertainties and to some degree the known unknowns. But working together, we can do a lot to provide solutions in what's a perilous period going forward, but the flip side of that is enormous opportunity.
Thank you, Steve. Lara, would you like to add something to that?
Yeah, I would love to. So, you know, I think Steve's right. We've got this how we move forward and the broader, longer term picture, and then we've got how we respond right now and in starting to think about providing solutions. One thing that going through this global pandemic perhaps highlights to everybody is the fact that things happen. And if we have an understanding of what coverage is, everybody's better off after that thing happens, right? So it's sort of prevalent in a lot of what's out there. And this goes all the way to the consumer and then through to the insurance company in their reinsurance and with reinsurers. What does the product you're buying actually provide you protection against? Do you understand the nuances of that? And are there things that you're worried about that don't actually sit within that product? And if there are, then how do we have a dialogue right now, this summer, about where those gaps are in the product, and then how we're going to solve that gap? Because I think we're headed into a lot of conversation around the financial implications of a global pandemic. And the fact is that, a lot of the work that the industry as a whole has done to prepare for calamitous global catastrophes didn't focus on pandemic. It focused on the massive earthquake, in Japan. It focused on the massive hurricane in Florida. And, we're pretty well prepared or have a pretty good understanding for those types of things. But there's a lot of other risk out there, and there's a lot of emerging risk that we don't necessarily have that same level of understanding around. And, God knows nobody loves spending their day reading contract wordings. And I've read more contract wordings in the last 6 weeks than I think I would ever necessarily want to. But that gets to the heart of it, right? What is the contract between the insurance company and the consumer? What is the contract between the reinsurer and the insurance company? And how do all of these things come together at the only time it matters, when you have a claim, right? When losses happen. And so, I know it's not a topic it's not a sexy topic like data science is, right? But it is a really critical aspect of where we can make a practical difference in understanding what people feel they're exposed to in terms of risk, where the gaps are, and then how we're going to bring capital to bear to fix those gaps.
So I just wanted to jump in because I'm compelled to observe that I after all these years, I still enjoy reading contract language all day long. So to each their own.
No, well, Steve, some people are uniquely suited to that.
and to double click a bit on what Laura said and bring it back to what George mentioned earlier, because George ticked through the contributions of the Bermuda market over a couple of wildfire seasons. Increasingly, the wildfire season seems to equal all year. But particularly for the second and third years, those were new tailored solutions, principally designed in Bermuda with the help of leading global intermediaries. So I think the perils of this year will be similar, that over the summer and the fall, we can work together to craft new solutions. Like with wildfire, we may well lose some money on some iterations of those in the next go, but the products are intended to respond, and they should pay off in known intervals. In many respects, the real challenge at the consumer level, if it's called auto policy, they expect to get paid on losses to their auto. For a homeowner's policy, they expect to get paid on the loss to the house. And it's for us in the B2B space, at times in partnership with government actors, to find tailor ways to efficiently find homes for that risk, diversifying it across the globe wherever possible into private hands. But I'm actually extremely optimistic that working together with a range of solutions, we will feel our way towards a set of meaningful tools will help address direct climate risks and risks that arise indirectly out of the growing climate situation.
As I suspected, we're probably reaching our last question, but we probably could have gone on for another half an hour or more. Before we move off this particular area and talking about the public-private partnership, I just want to open it up to the rest of the panelists to see if either of them had any comments that they would like to add, and then we'll move on to our final question. So I'll start. George, is there anything that you'd like to add?
No further comments, Suzanne. Thank you.
Thank you. And Andrew?
Now we can move on.
Okay, great. So moving on to technology and technological solutions. It's 2020, so surely technology can solve all of this. And Andrew, obviously with the Insurtech company on the panel, we're going to look to you for you to give us kind of your view on the part that technology will play in the kind of the future of risk mitigation and recovery with respect to climate change. What do you think?
Yeah, I think we're at a unique time, and I like to say that this wouldn't have been possible even 5 years ago, just where compute power was at, the cost of it, and just also the amount of data that was available. And now we're kind of at this unique position that so many other industries, you look at self-driving cars, everything that's come from the ad world for Google, and that they've done a lot of the groundwork for us in creating these initial quantitative methods to use machine learning or deep learning to better find signals in huge amounts of data and where there's a lot of noise, which is what we're dealing with. Again, I think that the main issue is trying to marry that technology background with the reinsurance and just greater insurance background. And again, Bermuda is just this shining example of not from the top down being so supportive of Insurtech, and also just what you see from companies and their own personal narrative and trying to reach out, trying to do investments and trying to do partnerships with a lot of these Insurtechs that are coming up. And one other thing I'd say too, and it goes a little bit into the last question, into this one too, we've been seeing so much when these black swan events happen, and there's just an over inundation of information and statistics that come out, and it's actually becoming really hard for people to know, oh my God, is COVID the next Black Plague, or is COVID just another flu? And even when you have responses from WHO and a lot of larger government agencies, I feel like there's a lot of noise out there, which is causing complexity and causing concerns. Reinsurance is in this great position where our livelihood and everything rests on having the correct response and understanding the true quantitative backing behind that risk, or what the true price is behind that risk or probability of it happening. So it puts us in a unique position that all of our interest is aligned in having a very unbiased view of what this risk is, the probability of it happening, and what the total effect is. And I think that puts not only reinsurance, it puts Bermuda as a whole in this great position to become a thought leader and an industry leader in trying to tackle some of these much more complex issues that we're going to they're unfortunately only going to keep growing in the future.
Thank you. Before we move off and I go to Q&A, you did mention and allude to this a bit, George, before in the other question, and you did highlight that your colleague would spend more time on kind of the BMA's response to innovation. Is there anything you might want to add, with response to what Andrew's mentioned with respect to the BMA and how they are dealing with the unique business plans that are now coming through in order to address the innovation present in the reinsurance market?
Yes, Suzanne, thank you. Very, very briefly, there is, from a BMA perspective, our objective is to make sure that our regulatory regime is continuously adapted so that we remain responsive and add value to the industry without having unnecessarily adding burden to the companies. And there is, as previously alluded to, Insurtech and the Innovation Hub and the Sandbox are two of the innovation steps that we've done. The other thing I would like to touch on is briefly on the licensing side. And what I'd like to highlight is, in response to these trends, the BMA has recently introduced 2 new classes of insurer and 1 new insurance marketplace class. So we have the new innovative insurer general business class, which is aimed at insurers that have digital assets as their fundamental business model, while you have also the insurance marketplace class, which is aimed to use technology throughout the life cycle of the insurance, and this would probably in a way help reduce some of the frictional costs and make insurance more accessible. Another area that another class that we've introduced recently is the collateralized insurance class, which is effectively a more complex SPI structure. So it sits side by side to the standard SPI insurer, but it has additional operational flexibility. And therefore, collateralized insurance class allows for trading with unrated cedents. It allows for using reinsurance instead of collateral, at least some part of the collateral, and it needs to be high quality reinsurance. It allows for a wider range of assets to be invested. And it also allows for the insurer to offer a wider range of products, including structured legacy covers. So to summarize, I just wanted to sort of put across some of the innovation steps that the BMA is taking, and particularly on the new insurance classes, licenses that we've introduced.
Thank you, George. So in the interest of time, I'd like to move us into Q&A. I will start with the first question that I'll start with is actually on COVID-19. And I will let my panelists fight over who gets to respond. The question is, stating that COVID-19 is a trifecta. 1, a previously unknown health risk with no near-term solutions or vaccines. 2, it's grown into a global pandemic. And 3, it requires very time-sensitive solutions. And the question is, how is the Bermuda reinsurance industry best positioned to address this and future program needs in advance of the next global catastrophe? Any takers?
I guess I'll jump in on that one. So I think for any situation that's that impactful worldwide, and this would relate to climate change as well, and a lot of the impacts and the necessary solutions that we're going to have to think through for climate change, it's not just one entity finding a solution. You really have to have a group of people dedicated, right, to being creative thinkers and to drilling into the problem. You've got a concentration of that expertise in Bermuda. So that's one aspect of it. But I would also say we've really got to broaden the perspective globally. It's multiple government entities that are going to have to partner with the reinsurance industry and the insurance industry to help figure out solutions. It's academia. It's tapping into entities, like BIOS on the climate change side and the research and the data that they have. And, for COVID-19 specifically, there is this tremendous amount of data and information. What does that mean? How do you apply that to solutions? So, I think at the heart of it is a need to have this expertise and brainstorming to really think creatively about what the solutions are, but then also to connect back all of the other partners and all of the other entities that 1, help develop those solutions, and then 2, can help execute on those solutions, because it's going to take substantial resource for COVID-19 and for climate change to actually execute and bring about the solutions that are necessary.
Thank you, Lara. Let's just try to field one more question because we're just about out of time. This question I think is for you, Andrew. The question is, how does this Insurtech capability drive business results?
I love this question. It's such an important one. And the flat truth is you can have the greatest technology in the world, but if the market dynamics are not there, it's not going to work. And my point being, you could have the greatest model in the world that's telling you what the price should be within 1% deviation. And if the market's demanding a lower price than that, then there's nothing you can do about it. I think it starts where you start looking where the insurance gap is happening and where there are uninsurable risks. So you look inside, our primary focus has been like wildfire, because there are multiple areas in California where people aren't able to get excess cover on their homes or are going completely underinsured, where you actually have this ability to affect market pricing and to bring some transparency to it. And it's similar to that on the transactional portion. And when you talk about Insurtech, really increasing that customer experience and increasing the speed of a total transaction, if you don't change the core product underneath it, you can't just layer software on a core product that is still very difficult to transact and has a lot of burden and kind of what we call tech debt built into it. And that's where BDA is incredible at it, is they're looking and they're always open to options of how do you really change the underlying product. So, if there is a future of swap markets and being able to do small coverage for short periods of times on specific peril, you really have to have that underlying fundamental structure of the regulatory and the actual product that you can then build some sort of transactional and technological layer on top of to rapidly trade it. So I think that is a great question and critical point.
Thank you, Andrew. And I think that's all that we have time for. So I would like to, before the BDA and RIMS come in to formally thank you, everyone, I would like to thank the panel for a robust and informative discussion today.
All right. I'd like to thank all of our attendees and moderator Suzanne Williams-Charles and panelist Andrew Engler, Lara Mori, Stephen Weinstein, and George Petropoulos for that wonderful presentation. Let's thank our host, Jasmine DeSilva, who has a brief message.
Thank you, Justin. I need to start talking just like you. Thank you, panelists. I really do appreciate the time that you took. And like Suzanne said, it was an informative and great educational discussion. The risk nerd in me loved every moment of it. So thank you so much for your time. As mentioned, this was the second episode of 5. So please join us next week for episode 3, which is focused on what's next for the ILS and alternative capital. Please come to our website, bda.bm, if you have any queries or want to know anything else about that's developing within the Bermuda marketplace. Thank you for your time again.
All right. Thank you, Jasmine. A copy of this webinar will be archived on Risk Knowledge on Opus Ed within a few days. The RIMS Bermuda 2020 webinar series continues, as Jasmine said, on June 17th at 12 p.m. Eastern with the session, What's Next for ILS and Alternative Capital? Visit rims.org to register for that session and all future ones. We look forward to seeing you every Wednesday through July 1st. Thank you all and stay safe.